Hey everyone, this is Jordan Thibodeau from the Silicon Valley Investors Club, and I'm also the author for Investors Therapy, which is a monthly newsletter dedicated on how you can become a better investor by understanding your own emotions and what you can do to make sure that your emotions aren't driving your investment decisions. I decided that I should start a series of YouTube interviews where I bring in people who I know who are either full-time, part-time investors or people who are not even involved in the investment community, but I think they have things to teach us that we can use to become better investors. I decided to have my friend Yeats, who's a former Googler and now a partner at Vela Partners, a venture capital firm that focuses on investing in B2B companies in the machine learning space, to join us to talk about how to be an angel investor. In this interview, it's jam-packed with tips on, first of all, what is an angel investment, what you can do to find angel deals, how to conduct due diligence, the risks involved in angel investing, how to write an angel thesis so you can narrow down on what types of investments you should make. Also, how to think about writing your first angel investment check, and then how to stay in contact with the entrepreneur and be helpful. We'll also talk about emotional traps that new angel investors fall into and what you can do to prevent yourself from falling prey to those traps. I hope you enjoy this interview, and please, you can do me a favor, hit the like button and also hit the subscribe button. Thank you. Hey, Yeats, thank you for joining us. Really appreciate it.
Thank you, Jordan.
You're welcome. Thank you for being here. Yeats is a good friend of mine. I met him back at Google back in 2012. He worked in the Google Cloud business, and after Google Cloud, he went on to form Vela Partners. Vela Partners is a venture capital company, and they invest in B2B businesses in the ML space. Yeats got his master's at Oxford in AI, and he's just a wonderful person and has agreed to share some of his tips on getting started angel investing, how we can analyze deals, and then learn more about venture capital. So Yeats, thanks for joining us.
Thank you, Jordan. I'm really excited about the session.
Awesome. So let's start with the first question. What is angel investing?
So angel investing is personal investing into startups. So you don't use other people's capital. You use your own capital and you invest in private companies at their formation stage. So they're just an idea. There are just a few people and they come to angels and you invest with your own personal capital.
Gotcha. And compared to investing in publicly traded companies where you kind of like set it and forget it, what makes angel investing unique? Can we like contribute our own skills to the deal and help out in other forms?
Yeah, there are three dimensions that comes to mind that is different than public investing. So the first one is liquidity. So in public markets, when you invest, you can get liquidity anytime. If you decide to sell it, you can sell it. In angel investing, you can't. It takes a lot of time to be able to get your money's return. The second thing that separates angel investing from public investing is that you can get significant returns compared to public investing. What this means is that, yes, in public investing markets as well, you can get multiples of your capital as well. But if you, I will say, like, get lucky in angel investing, you can get 100 to 1000x, maybe 2000x of your capital if you invest in the right company and you get lucky with that. And the third difference is that, like, maybe personal satisfaction and personal, involvement in the business, that emotional part of angel investing, which makes it more fun because you can contribute to the team with your skills, not only with your professional skill set, but also building a good relationship with the founding team that, you support when there are only a few people, and the satisfaction that you see from creating and contributing to a business where it may grow to thousands of people and providing that employment to thousands of people just because you angel invested and support the company and contributed to their growth.
Right, you can have tremendous impact, and also you mentioned you can help them. So maybe if you have a network or introductions that the that the CEO needs, or maybe you can connect them to the right customers, so you can actually be hands-on to a degree, correct?
Exactly.
So what are the requirements to be an angel investor?
So you need to be an accredited investor. And what accredited investor means is that you either need to have 200K salary over the course of the last 2 years, or you need to have at least $1 million assets on top of your primary residence. But there are also platforms that you can invest as non-accredited investors in, as like the crowdfunding platforms that you would be able to use. So that's another way to do it. But if you were to do it like individually, you need to be an accredited investor to make those investments.
Okay. So you can, if people aren't accredited, you might be able to, are there such things like friends and family rounds where if you might know someone who's a part of the deal, you could get in, or is that not possible?
Friends and family rounds is exactly that. Like you can invest just because it's your friend and it's someone from your family, so you would be able to invest because you have a personal relationship. The reason why this law exists is that the government doesn't want people to just invest in people that they don't know, and this is like a very high risk asset class. So as a result of that, like there are these like rules and regulations to make sure that people just don't put their life savings in these very high risk companies.
It's a very good point about the risk aspect. So can we talk a little bit more about that? Because it seems like the vast majority of startups don't actually make money, or they don't even break even. So can we talk about the risk aspect of angel investing?
Yeah, definitely. So as a VC or as an angel investor who invests in seed stage deals, seed stage meaning a few people, companies in the idea stage or in prototype stage, there's a high likelihood of like those companies not working out and just going bust. And when you look into from a number standpoint, what that means is that 80% of companies don't even make any money and they go bust, and maybe 20% gets liquidity, but that liquidity doesn't mean that you would get your money back. Maybe it's just like a talent acquisition that you don't even get your money back, or it could be like 30 cents to $1 that you invested. So the real capital that you actually earn is from like a very handful of deals, maybe almost like 1 out of 20, that you would be able to make like 10, 100 or 1000x from like one deal that could bring like the majority of the returns of your portfolio. So the way to think about it is like you know that like this is like you will have outlier return, and you need to assume that like you will lose majority of your capital in most of the companies that you invest.
And definitely good to know. So then we should probably not, if we only have like $50,000 to invest, we probably shouldn't just write one check to one deal. We should figure out a way of maybe using the Kelly criteria and making 5 different bets or whatnot, so we can at least see some type of repetition, correct?
Exactly. Typically what I say to my friends is that like determine that number and at least divide it by 10. And that's how you should invest into, early stage deals. And if you like how things are going with the 10 deals that you made, continue and try to reach 20 as a portfolio, and don't do it on a short time period because there's like the risk of like investing in a certain period of time. So you need to think about this as a very long-term business where like maybe you invest in 10 deals in 2 years, maybe you invest in the next 10 in the next 2 years. So you have like a portfolio of investments over the course of like 4 years.
Excellent. So that's one way for you to diversify your investments and try to minimize your risk. But you always should go into every deal assuming, hey, I could get wiped out by this investment. Am I okay with this risk? Don't think, I really need this money a year from now, or 5 years from now, make a down payment on my house. In that case, you probably shouldn't be doing an angel investment. And that gets to my next point. What's the holding period for some angel investments?
The typical holding period is 8 years and more. So it's a very long period of time, and it's growing in the last years or so. Like when you look into the late 1990s, the holding period was around 4 to 5 years because companies were going to public earlier. Now there's a lot of capital in the private markets that just enables these companies to stay private for a long period of time. So the public companies going to IPO typically takes a minimum 8 years, but in average, currently it's like 10 years or so. But assumption should be 8 years. But as a result of, this trend, now there are secondary markets that you can go ahead and sell your angel investments after a certain period of time, but it's not guaranteed. It's not like, it's not pretty clear that you could do that because there may not be like secondary market buyers. So there's that like possibility of getting a kind of a liquidity like after 5 to 6 years, but it's not guaranteed.
Right, and you might have to
8 years.
Okay, so if that situation happened where it was on one of these markets where you could sell in secondary, there would probably be a steep discount that you'd be paying and probably tons of transaction fees, and it just would not be good.
Definitely, that's exactly how it is. Like if you can hold it, because that's kind of like the end game. Because if secondary market investors want to buy your stocks, it means like they're expecting that it's going to grow. So it's better to hold on to them if you don't have like any information that they don't. If you have like a better information, asymmetric information, maybe it's a good idea to sell at a discounted rate, but typically it's better to hold your investment and your stocks if you don't need the capital at that moment.
Okay, that makes sense. Now let's get to the next step. Where can I find angel deals? So we mentioned Angel List is one place, but how can we maybe use our own networks or our own advantages to start getting angel deals to come to us directly?
Mm-hmm. I would look into deal flow with two different perspectives. One is like the reactive approach, and the other one is the proactive approach. So reactive approach is like you basically get the word out among your friends and family and your colleagues that you're an angel investor. And as a result of like that word of mouth, like some people may just come to you or may get referred, but this word of mouth impact really takes time. So the other way of like going and figuring out like new deals and finding new deals is like going to the events, startup events, going to Y Combinator, 500 Startups demo days is a way to, find deals. But I call them like these are, more reactive and more like, these deals are accessible by everyone. So you don't have much competitive advantage to win those deals or get into those deals. So it's better to find like unique ways of, what your edge is from an investment standpoint. So I would call that approach as proactive approach, and everyone has a different proactive approach based on their skill set and the edge that they have. So one way to look at proactive approach is that you might have an investment thesis around like say you see that Uber is growing very fast and you like that business model, and say you are working at Uber. So ins and outs of that business model and how that marketplace dynamics work. So you might build that investment thesis around Uberized companies, and then you can go ahead and do your own proactive research and outbound reach to the startup founders. And the way that you could do it, once you determine your investment thesis, you can search on LinkedIn, you can search on Crunchbase. So instead of deals coming to you, you go and find those deals yourself, and talk with as many companies as possible specific to your investment thesis, and try to get into them by providing more value other than your capital, your skill set.
That's so huge. I wanted to write down the investment thesis things. I thought that was just a really good idea, and how you dovetailed that into what your own advantage is. So can we first talk about what is an investment thesis, how we go about creating it, and also why it's important to have one?
Mm-hmm. So maybe I will start from like why it is important to have an investment thesis. As an angel investor, like after some period of time, like at first it is going to be like very slow. So no one will know you. But after a while, once you make a few investments, people will start to get to know you, and you will just receive deals from left and right. So you will see deals in Y Combinator in one batch. It will be like more than 100. Then in 500 startups, then your friends will send it, your colleagues will send it. So you will be really overwhelmed with the deals because your time doesn't scale. So as a result of that, like you might get distracted very easily. You might get deals that you don't know well enough. So since your time is constrained, you need to focus on things that you know well, so that you can do the analysis properly and have like some conviction around the deal very fast. So why it is important? It is important because the time is limited and you need to prioritize your time extremely well. And the second thing is that like you don't want to get, I would say, like convinced to the deals that you don't know well enough, because if the entrepreneur has a good pitch, if he's or she's a good salesperson, you might get convinced into deals that you don't know well enough. So one is like the priority and managing your time properly, and the second one is like building a conviction yourself that like you can analyze it properly and you believe in its future growth. So once you understand like the importance of creating like an investment thesis or like how you want to prioritize your time, then you need to you need to do like first principle thinking around like what are the things that like that is going to grow in the next 5 to 10 years. And assuming that Jordan, your audience is tech professionals and entrepreneurs, people are exposed to these ideas in their companies and where they are going almost every day. So people know like where things are going and from a technology standpoint, so you can build your own conviction about the future and what you expect from that future and what you need as of today and 5 years from now. So once you know that like conviction, you really need to at least write and articulate what that is, and once you articulate that, then you can codify it. And if you codify it, then you can make decisions much faster and easier because your top of funnel will be very wide. So you will need to filter very effectively. So investment thesis, I gave that investment thesis as an example. Like if I was an Uber, employee in the early stages of the company and knew that like this Uber model, location-based services is something that is going to grow fast. And if I was seeing that growth within Uber, then I would look into different verticals that could be applicable and reach out to those entrepreneurs or get myself situated for potential entrepreneurs to reach out to me. So that's how I think about investment thesis. But as an investor, you should not also just you should not be closed-minded. Like, yes, investment thesis is important, focus is important, but you don't know everything, and you won't, and no one knows everything. So it's good to have like that 80%, 20 to 20% prioritization in your mind, where like 80% is your thesis, that's what you are going after, but keep an open mind for the other 20%. That like, don't be closed-minded, And if you get like something very interesting that you can understand and think that, wow, this is like a great idea, spend some time on it. And if you have like interest in learning, like that's also an important factor of, keeping an open mind to new things, because the important aspect of angel investing is personal growth as well.
It's fantastic. You hit it out of the park with that one. I look at a thesis also kind of like the Constitution. The founders never thought it was perfect, but they also have amendments on the Constitution and the ability to change things and update things as things go. So you kind of look at your thesis as a living document. But more importantly, it talks about the secular trends about the industry you're looking at. So the thesis kind of tells you this is where the market's going in general, and this is what I have a conviction for. And then that allows you, I believe, to narrow down what exactly firms will do well in said market. Exactly. And also how your skill set lines up with the investments, because I will come across angel investors who will turn down deals and they'll say, hey, this is an excellent investment, but I have no value to add to this. I don't really understand the market. So I want to be more comfortable with what's going on. So this ties into our next point. Let's say we do things to develop deal flow. And one thing I thought about for deal flow is a simple thing is updating your LinkedIn profile and being like, this is what my job is, but in the title put, and I'm also an angel investor. And you would be surprised of what type of flow you would get from that, or joining angel investment groups and Facebook groups or whatnot. But going to the investment flow, how many deals do you look at before you decide to make an investment?
So we have two ways of finding deals. So one is we call it manual way of finding deals, which is like, referrals, going to the events and just being aware of, deals that are, within our network. And the other approach that we have is a algorithmic and tech-driven approach. So we have an algorithm that, scans the web and prioritize them based on our own heuristics and machine learning algorithms and brings them to our attention. And we call it like automated deals. So when we add them up, like the deals that we are looking into manually is 40 companies a week. So in a quarter, it's about 450 to 500 companies. And just, if you round that up to 500, we invest somewhere between 1 to 2 companies. So if you just look into it as like, 1 per 500 would be like a good ratio for us.
So if I'm new to angel investing, I probably should not write a check to the first investment I see.
Exactly. That's exactly like I recommend to my friends as well. Just see at least 20 deals and then, don't make a quick decision about like the first deal that you see, because you get extremely excited. The CEO is very passionate. They tell a really good story and you are just like dreaming about, what can be, when you hear like the first deals, right?
You're dreaming about your yacht already.
Well, the market is huge. They are like going to kill it. So, but after a while, once you build your own, seeing like a lot of deals just educate you, and you just hear like same stories again and again, how things turn out like after a few months or 6 months. Then you start building your own algorithm in your head that like, okay, you have your own pattern matching algorithms in your mind after seeing at least, 20 to 30 companies.
That makes sense. Now, this is a big question, but what makes a good angel investment?
So Jordan, we look into 4 dimensions when we evaluate a company. So the first one is team, and the other one is the product. Then we look into the market and business as well. So I will break it down like what these dimensions mean to you, so that like, because those 4 dimensions are a little bit abstract. So when we look into the team, we look into the founding, the CEO and the CTO. Do they have like complementary skill set? That's very important. The other aspect that we look into is whether a CEO is a good storyteller. And if he's a good storyteller, it means like he would be able to fundraise, he would be able to, bring new team members, recruit well, he would be able to sell, he would be able to partner. So it becomes like a really important part of our, evaluation of companies. The third aspect is like, is the CEO and the team on top of their numbers? They may not have launched their product, but they should be knowing a lot about the market and other competitors, and what people think, and they should have had done their UX research and talk with their target customers. So we ask a lot of questions to understand whether they did their their homework and are detail oriented and on top of their numbers. So the first thing is, team. Like, it's really, really, really important, because at the end of the day, they are the ones who make decisions, and we believe in the founding and the management team, and that's why we invest. But of course, you can have great teams, but if they're not at the right markets, then it may not matter, right? Like, even though they might pivot to different business ideas within that market, if that market is not promising, then that's not something that we get interested. So we look into the market, and the market could be, anywhere between, it could be a transportation market, it could be, supply chain market, it could be recruitment market, and so on. So, for example, a recruitment market is an area where we don't look into at the moment, because we are worried about an upcoming recession. So recruitment might get negatively impacted. So that's kind of like a no for us. So if even the team is great, if they are operating in recruitment software market, we don't go after that. We don't invest. Then the other part is like, okay, you have like a great team. Do you also have like a sizable business that you can create from operating in this market? So we look into the potential of the business. Like, can this be like at least a $50 to $100 million recurring revenue company? If we can make like a back of the envelope calculation, like very simple bottoms up, that, okay, if they reach like, 3,000 enterprise customers, if they're able to charge like $100,000 a year contracts, okay, this, then you multiply them, and you just make like very simple bottoms up calculations to see like whether this company actually can reach that. And then you look into the competition, of course, like in that market, to see like what other companies have been doing, how big they got, the incumbents. So that gives you some anchor, points that like, okay, this kind of makes sense. Then after, evaluating all those, abstract, but very important points, kind of subjective, you move into the product and the idea specifically, and look into the quality of the execution of the product. So sometimes founders may not have a product, they might have a prototype, but you might see like some nuances on, the detail orientedness of the team and the quality of the execution. Just by even looking at the website, like if you see like typo and things like that, like it's not a good signal. So you look into the product, and also idea needs to make sense. Like idea needs to be a good idea. Like it's not, I know that like people change their ideas, but sometimes they don't. And sometimes they're like great ideas that just work right at the beginning. There's like this thing that pivoting is important, and you change because most ideas are not that good at the beginning. But once you hear like a really good idea, it makes sense that like it's a really, really good idea. So it's also important to evaluate the product idea itself, and you need to feel like, wow, okay, this is a very clear idea and very clear product.
That's a good point. And also, you might want to see if the founders validated this idea. What makes me excited is when I see founders who have already primed the pump and bootstrapped certain aspects and have a degree of a customer base, but they just don't have enough money to start scaling up. That's usually a positive sign.
Exactly. That frugality of the founder is also very important. Like, are they resourceful enough that, without outside funding, did they get something together? Did they build something? Did they make any progress? Because you will see like many founders, enough founders that come and you just see that they may not be resourceful. They just, ask for resources to build it, but they can actually do it themselves while they are, by themselves or with a small group of team members.
Right. Because most angel investing I see outside of biotech, whereas biotech, you probably need a couple million to get things going for a certain degree. But most SaaS companies, I mean, you just need an internet connection, a laptop, and some coffee to grind out certain ideas, and being able to talk to customers and see if they like what you're thinking about doing, iterating from there.
Exactly. At nights, at the weekends, moonlighting, like these are all optional things, and that I personally see people do. And when I see that, like, I get excited. Like they have a skin in the game. They are like really passionate and they want to get this done.
Excellent. Now, let's say, I mean, there's idea investing, angel investing, but then there's also, let's say they actually have things going and things are moving forward. What are some indicators that you use? Like maybe you can explain like the lifetime value of a customer or the cost of acquiring a customer, net churn. Can you talk about some other not deep financial metrics, like trying to figure out like discounted cash flow and stuff like that, but more of back of the envelope measures you can use to see if this early investment is actually viable?
Yes. So, the dimensions that I talked about before is like, conceptually, is this like a good company? And, you can evaluate with those dimensions pre-revenue companies as well. But once the company has some revenue and has some customers, then you can start evaluating the company based on like the metrics that they have. And the best ones that, we look into, if you're investing in enterprise software, SaaS, or even like consumer companies as well, you might have early indicators of some of the metrics that might be interesting for you. So the first one is like the customer acquisition cost. How much does it cost to acquire a customer versus like how long does it take to pay back that customer acquisition cost? So we call that payback period. So if you were to acquire a customer for $10, does it take only a month for you to pay that customer's acquisition cost? And how long does that customer stay? And as a result of that, you can calculate like the lifetime value as well. So customer acquisition cost, payback period, and lifetime value. But most of the early stage companies don't have lifetime value. So you would be able to calculate, the health of the business based on the customer acquisition cost and the payback period. How long does it take? And then you can see like, are there any churns in the business? What's the churn rate? Like payback period could be very short. It could be like a month, but maybe customers are churning on the second month. That's not good. So if you are evaluating the company like after the 6 months of like when they started the revenue, and you are seeing like 1 month payback period, and customers are still staying after 6 months, that's a really good business. It means like it just takes a month to pay, and then the rest of the 6 months is just profits for the company, revenue for the company. That's a fantastic business. So a customer acquisition cost, payback period, and the churn period per customer, a return period for the customer.
Fantastic. Now, let's say we find a good angel investment. Where can we start doing our own level? Like, how can we do our due diligence? What are the best ways to make sure that we can lessen our risk? Like, how do we background checks on the founders, things like that? What should we think about?
There are so many things that you can do in due diligence, but you have like limited amount of time that that you can do. So as a result of that, like you need to identify the key risk that you are concerned about. And you should not run like a standardized process for like every angel investment in the same way, because they may not have the same risk that they are carrying. So identify that key risk. Are you worried about like the relationship between the founders? Like, did they work before? They did not work before? Then you focus on like the founder diligence, meaning you need to call your contacts, you need to ask the founder, people whom he worked with, so that you can have a conversation with them as like kind of like a reference call, as if you were hiring, someone to your company. So it's the same process. So if you have like concerns about that, if you have concerns about the competition, then you really need to spend time in analyzing the market and the competition. You need to look into the companies that are operating in the same market. If you have like contacts in those companies, have a conversation with them. If you can look into the traffic signals of those companies, how much money they raised, checking them on LinkedIn, how their team looks like. There are like lots of interviews about successful companies, so you can get a lot of information about the competition just reading and on internet and finding relevant information. So you need to identify what the key risk is and then focus on that. Like another example, if it is the market size, then you need to do your deeper research on the market size, like what it means to operate in this niche segment. Like, can they actually dominate this niche segment, which is fantastic, and can they replicate that model for other niche segments? Maybe it may become like a big company, but you need to convince yourself that like they can replicate whatever that niche is for other niches. So you need to build those like rationales that like, okay, I'm concerned about this, I did my research, and I'm still concerned, and that's like a deal breaker for me. Then you may decide not to invest. But after you do some research, you might feel comfortable about what you found out. Maybe yes, founders did not work with each other before, but just talking with them and like background checking them from other colleagues, maybe you may find out that like they are really easygoing people working with each other. You maybe other people have never observed that they had like conflicts with other people. So then, you might feel more comfortable about the fact that like they did not, work with each other before, or like the way that they interact with each other in front of you. Maybe you can, go for a dinner with them and you can see like how they are interacting with each other. So those are the things that like you can do as an angel investor. Just, being very, careful about the time that you allocate for due diligence. But it's very important to allocate that time.
Those are very good points. I like the idea of key risk, because there's tons of risks involved in the deal, but there's going to be some risks that are going to outweigh the other risks. And so if you can find those key risks and try to scope them out as much as possible, that can at least save you a lot of time. And then you have to ask yourself, okay, am I okay with that risk now? Another thing about startups is, especially in tech, it tends to be winner takes all in certain markets. So if you find a company that's going to jump into a crowded market, if it's kind of a Me Too play, you're running yourself into competition, lower margins, and something that might be an okay business, but not a great angel-worthy investment that's going to give you multiple or it's going to give you multiples on your capital invested. So instead of just you're looking for something that's 10x, 20x, 30x, not something that's going to barely give you 20% of your money.
Mm-hmm. Mm-hmm. That's a very good point, Jordan. There could be great businesses that could bring like maybe 10x of your capital, or for the founder, it could be a great business that they can be making maybe $1 to $5 million annual recurring revenue. That's amazing. Like if you have like 4 or 5 people working together, like running a profitable $5 million ARR business, that's an amazing business in my opinion. But is that like a investable business as an angel investor? Probably not. You would get like a better return for your capital if you were to find a company that could reach 100 million annual recurring revenue business.
It makes sense. We call it, well, I think the term we coined was VC lipstick on a pig. You see a lot of companies right now in our capital markets that there's so much VC money out there they're putting money into traditional businesses and trying to say they have an app or something, when it's a regular traditional business that the only reason why it's scaling is they're getting free money. But then once that free money runs out, then the music stops, the company is worth nothing. So let's get to, okay, we find a company, we like it, we do the background, due diligence, everything's good, and we want to cut a check to the founder. What's the paperwork involved, and how's the investment structured? And then what are things that we should look for in that paperwork?
Mm-hmm. At the moment in the Valley and most of the United States, people use this agreement called SAFE. It's an agreement for future equity. So it's kind of a loan that you provide, and in the future, it's going to convert into an equity, a percentage within the company. The reason why there's no, like as an angel investor, you don't do like a specifically equity, percentage based investment is that it requires a lot of paperwork. It requires a lot of, time to negotiate exactly the deal on the shareholder agreements and so on. So as a result of that, Y Combinator created the concept of SAFE, which is like a more practical agreement than convertible loan, more friendly to the entrepreneur. It's more efficient from like a paperwork standpoint. It's just 3-4 pages document. You read, you understand it. It's not like, it's not filled with landmines of different, conditions. So you get it, founder gets it, you as an angel investor get it. There are like few conditions that you care about in that agreement, which is like the valuation cap and the discount rate. I can get into details of that. So the valuation cap is one of the things that you should negotiate with the founder. Typically, the founder has an idea about what that valuation cap is, but if you are the first angel investor that you are talking with, or one of the first, you have an opportunity to negotiate. So a valuation cap gives an opportunity for you to, get a favorable valuation because you're investing earlier. The valuation cap could be like a $5 million. You might be investing $50,000. And as a result of that, like if the valuation cap is post money, meaning once the capital comes, the valuation cap stays as $5 million. You invested $50,000, you get like 1% of the company. So this happens in a scenario where like the founder fundraises from VCs that does like the percentage equity round, and the VC invests in $10 million valuation. But you invested early and you had that like $5 million valuation cap. So as a result of that, you have like 1% of the company instead of 0.5% of the company. $1,000 divided by $10 million. But there might be scenarios that at the moment, at the current conditions of the market, it's not happening, but it might change in the future. So you might be investing in a company at a very high valuation cap. Well, it might happen. Like, a founder might say valuation cap is $15 million, and angel investors might agree with that. So the part that like discount rate comes into the play is like when a VC does an equity round at a valuation that is lower than the valuation cap that you set. So say that you invested $50,000 at a $20 million valuation cap. Then the VC comes and say like, no, it's not $20 million. It's actually $10 million. So then what happens is that like suddenly your $50,000 that you had is like, is not getting like any sort of like benefit of being early, right? Like you just get like the same equity as like the VC who came later than you. So this is the part that like the discount rate comes in. If you also negotiate the discount rate, say 20% discount rate, it means like instead of you getting your equity at a $10 million valuation, you get it at a 20% discount rate. So it means like $8 million. So $50,000 divided by $8 million, you have your 20% advantage or like premium that you got because you were early.
Right. I have a question for you. So let's say a founder gives you a SAFE agreement and they say their valuation is something that you think is higher than it should be. Do you have room for negotiation? And also, does a founder have that ability? Because then let's say they already signed SAFE agreements with a valuation cap in place. Is it pretty much just set in stone at that point? What happens?
It is typically set. So if they signed an agreement before, they wouldn't want to decrease the valuation because it means like they will have to decrease the other one as well from an ethical standpoint. So it's hard to negotiate it down. So what founders do is that like they create batches of batches of valuation sometimes. Like they say for the first 250K who invest, it will be $5 million valuation cap. If you pass like within 2 weeks or 250K, I'm increasing to $6 million or $7 million or things like that. So that is like the thing that we observe in the market at the moment. But you can negotiate. For example, if you sign an agreement with $8 million or $10 million valuation, or sometimes you might sign like uncapped, meaning no valuation. There's a term that you can use in SAFE that is called most favored nation. So what it means is that like it protects you if the founder signs like another SAFE at a lower valuation cap. So your SAFE immediately converts into that like lower valuation cap that the founder signed with another investor.
Do you look for that in your SAFE agreements?
If we do like a uncapped valuation, yes, we would want that. But at the same time, like we, do a lot of due diligence to the founders and feel comfortable and trust. And we, trust that like the valuation cap is, they're going to stick with it.
Gotcha. So you would say like maybe, I don't know what percentage, like greater than half, or usually you just stick with the valuation they put through there because they've actually thought through it well and you go from there.
Yes.
Yeah. Okay. So can we talk about another concept, dilution, how that plays into a fact of your investment?
Yes. So dilution means that every time the company fundraises, brings more capital, they have to issue more stocks. Since as an angel investor, you own a certain number of stocks, and when the more stocks are issued, you get diluted. So you own less percentage of the company. And this happens when you invest in the angel round, then they raise their seed round, they raise their Series A, they raise their Series B. With every round, you can estimate that you will get diluted about 20%. In order to protect dilution, it is important to ask for the pro rata or anti-dilution right in the SAFE agreement. So you should check, valuation cap, discount rate, and pro rata right. So what it means is that like you own a certain percentage of the company and you have the right to put more capital to protect your shares. It doesn't mean that you will protect your shares forever without putting any capital. It just means that like for the amount that they are raising, you are getting diluted to 20%. Whatever that valuation is, you have the right to protect that 20% dilution by putting more capital in.
And is that in the SAFE or is that in the later phases?
It's in the SAFE.
Okay, excellent. Fantastic. So having the ability to follow on and invest more and protect yourself is really big because if you find a winner, you want to be able to put more capital into it.
Yes. Sometimes at the current conditions of the market, what is happening in the market is that even though you might have anti-dilution or pro rata rights, founders might ask for you to just give up that right because the VC in the later rounds might say like, hey, we want to own this much. You got to talk with your investors to give that up. And as an angel investor, you get basically squeezed by the later stage investors because you don't want to pass out and be the bad guy for the founder that I want to have my shares. So what happens is that like some angel investors and seed funds are giving up their pro rata and dilution rights to bring like later stage investors.
That makes sense. And also, the VCs sometimes they lead the round and then they start doing more due diligence and they expect they should be able to call the shots.
Yes.
Can we talk about, now you wrote the check and now the startup has your money. What do we do after that? Like, how do we follow up with the founder on a regular basis? Like, what should we be doing?
Yeah. Organized and good founders send either monthly or quarterly updates. And in the very early stage of the company, we observed that founders are sending monthly updates and they are like really structured. So they provide the update about the business and they tell exactly like what type of help they would need from you as an angel investor. This could be like a recruitment help. This could be like a customer referral help. It could be business model ideation. It could be like, contract negotiation, how to do like enterprise software contracts, right? So they lay that out like in every month in the email. And if they're like really communicative about their company, that's like how you get involved with the founder. Typically, we keep like a strong personal relationship that we catch up in a regular basis. Typically, like we would want to do at the early times, like at least once in a quarter, we would like to meet with the founder and make sure that we are helpful to them. But if we see that like the founder is operating great, and we believe in the management team, like we always stay out of the way. Like if they don't need help, like we are not going to just go there. I want to help. So what we are doing is that like, okay, how can we help you move forward faster? Is there anything that you think we can do for you? Sometimes you can do proactive things as well. Like founder doesn't need to ask something, but you might just be in a conversation and you might be like, wow, this could be a customer. Or you might be meeting with someone that is fantastic and wow, this friend of mine could be like a great engineering leader in this company. So you can do like lots of proactive stuff. And what you can do as well is you can talk with other investors and make sure that like you promote the portfolio company that you have to seed VCs or Series A VCs. So you can do lots of proactive things to help your portfolio companies to be successful.
That's excellent. I see you do that a lot for the companies that you invest in, which is really, really helpful. And you also knowing who their desired customer is and checking your Rolodex and seeing if you can bring them leads and close deals for them too.
Exactly.
So let's say people like the concept of investing in startups, but don't have the time to do all the due diligence and all the necessary work, and they want to instead invest in a VC like Vela Partners. Can you talk about how that process would work and how you guys are structured at Vela Partners and how you, I noticed you have multiple employees working at Vela Partners as partners, how you guys go about discussing opportunities and vetting them and whatnot.
Mm-hmm, mm-hmm. Yeah, the way to look into the VCs, like if you don't have the time to do it because it requires a time commitment, is to invest in VCs or syndicates of VCs, special purpose vehicles of VCs. So the way that I would evaluate the team, the way that I would evaluate the VC is like the team that they have, whether they have like the right background to make investments in that specific focus that they have. The second thing that I would look into is their investment thesis. Like, is that something that I'm excited about to back? Is that something that I believe in? So investment thesis is the second thing that I would look into. The third thing that I would look into is their processes. How are they, running their investment processes? No one knows which company is going to be successful. But if you run a good process, you can weed out bad investments. So the way that you should evaluate the VC's third dimensional process is like how they think about investing, how is their investment philosophy, how do they find deals, how do they evaluate them, how much time it takes, and so on. So the third one is process. The fourth one is track record. Like, how you look into the startups, like their traction, how they are doing from numbers standpoint. You can also ask VCs of their track record. And what track record means is that, their portfolio. How is their portfolio appreciating? Has there been any, outliers? What's their IRR, their return rates? Some may not because they might be early. So what are like the on-paper returns? Has there been any liquidity from the investments that they made, and so on? So these are like the four dimensions that I would evaluate the VCs. The thing with VC asset class is that you also need to figure out a way to invest in VCs, and most VCs have large minimum check sizes that they accept, and as a result of that, some of the VCs may not be accessible, sometimes due to check size and sometimes the fund size. They might be like over subscribed. So
what's like two questions? Is there a lot of regarding check size? What's the average check size you see? And the second, is the reason why they don't look for lesser amounts due to like all the paperwork involved of taking on investors? Can you talk about that?
Yeah, traditionally, like the paperwork and accounting is just like a lot of work, and convincing someone to provide their capital to you is a very difficult process. So it takes a lot of time to build trust, because you say like, hey, give your capital to me and let me invest for the next 3 years. So it requires a lot of trust and relationship building. So as a result of that, most VCs go and build those relationships with institutions or high net worth, ultra high net worth individuals or family offices who can write larger check sizes. It's kind of like enterprise sales if you think that way. Mm-hmm. Like it's high, sales cost to build those relationships. So you go for like the highest that you can go, so that you can minimize that amount of work with the highest return on investment of your time. So typically we observe that VCs accept like from individuals 250K commitment over the course of 3 to 4 years of investment cycle at minimum. But now, like this is a little bit inaccessible to many people. But syndicates are enabling more people to invest alongside with VCs. So VC fund is a concept of like you commit the capital and VCs just take care of it for the next 3-4 years investing, and then they return it like after 10 years. The other concept that the VCs run is the concept of syndicates. And what they do is that they have their own fund that they're investing from. But they also create a syndicate, like an entity that you can invest deal by deal basis. So if a VC is investing $500,000 to a seed deal, they might also create another syndicate that could collect more capital from their own LPs who want to double down because they just like the investment, or they may want to bring like new LPs, new investors who could maybe add value to the company, or who could be like candidates for their funds as like new clients. So with the syndicate approach, you can write as small as like $1,000 in AngelList platform, as big as like the syndicate has a spot. So AngelList, Assure, there are like these companies that are enabling both VCs and angel investors as well to create these entities that amplify their check sizes, that gives that scale of capital and negotiation power into the deals.
That's fantastic. There's just multiple ways to get involved now compared to where it was 10, 15 years ago. Mm-hmm. One thing I want to talk about is at Vela Partners, you have this model, a champion model, where a partner goes out, finds a deal, and then brings it back to the rest of the group, and you guys kind of hash it out. Can you talk about that process, and then also maybe how people who are angel investors, how they might be able to replicate that with maybe their friends or other trusted advisors?
Very good question. So it took some time for us to, figure out like our processes. So I'm excited to share that because it's important to have a clear process. So what we do is that there's typically a champion partner or a lead partner we call, and the lead partner finds a deal. He can find it through any of the deal flow channels that he has. So once he has that deal, he engages with the entrepreneur and he does the first meeting. And the first meeting is all about understanding the opportunity and whether the champion partner shares the same view as the entrepreneur. And he then makes a decision whether this is something that he's also excited about and wants to take the deal to the next stage. So after we do, champion partner does the first meeting, he talks with a devil's advocate partner. So devil's advocate partner is the person that, that he wants to lead the deal with, but that devil's advocate partner is the person who looks into why this deal may not be a good one. So he would look into the risks. So they would discuss, and we would discuss, I would discuss with another partner. And then if I have like a good convincing argument, then we say like, okay, let's schedule the second meeting. And in the second meeting, the devil's advocate partner runs the meeting and tries to identify the risks in the company. This could be risks in the team. This could be risks in the business itself. This could be risks in like product market fit. So we have like set of questions to identify those. And after the second meeting, two partners get together and decide whether it is worth pursuing due diligence, because it will require a significant amount of partner time versus like going and finding new deals. So they discuss, we discuss with, with each other. And if there's like a, agreement on let's pursue this deal and let's, figure out, what type of things we should deep dive on, the lead partner starts a process in the company. So he shares like the pros and cons about making an investment, does like a summary of the company, and then shares it with the rest of the partnership. And everyone, shares their thoughts and they take a position, either positive or negative, slightly positive, very positive, slightly negative type of a position. And then they also identify like some of the key concerns that they have. And once you have like 4 or 5 partners, you see like the key concerns emerging. And since you poll it, like you see, okay, 3 other partners are concerned about competition. Like I should really spend time on understanding the competition. Or, the secondary concern is team, and everyone's talking about the same thing. So let me take these like 2 different points and let me spend time for the next 2 weeks to understand like, what these key concerns are and whether I can mitigate those concerns by digging deep. And once, the lead partner identifies those, he does his own due diligence. And then if he still feels comfortable after the due diligence, he writes an investment memo and presents it to the committee. And if the committee feels positive, then the entrepreneur is invited to make a presentation. Most of the time, it's just, getting to know each other and, getting to know the partnership and ask some concerns that the other partners still have. And right after that meeting, we make a, hard commitment, and then, the paperwork and everything starts after that. And this process in total takes 3 to 4 weeks from the first meeting to making a hard commitment. And throughout the process, the entrepreneur is notified like every 2 days, after each meeting. And during due diligence, there's like a very close interaction with the lead partner. And if, of course, the entrepreneur feels mutually positive about the process, we continue to move the process forward.
That's fantastic. Now, I was trying to think of ways that an individual investor could replicate this. And maybe that's like creating a mastermind group. You might have some other people who are in the field that you're interested in to invest in, maybe passing them the deal and saying, hey, what do you think about the pluses and the minuses of this? Or going to specific people like who are in sales, people who are in marketing and things like that, and saying like, hey, what problems do you foresee in doing this? Can you give me some strong arguments for this and against this? And that could be one way to mitigate some of our own cognitive biases on when we find a deal, because sometimes we get married to it. So that kind of brings us to our next point, where for investors therapy, we like to talk about when we make investments, it's more of you trying to get a better grasp of your own emotional climate and understanding your own emotional biases and traps that can prevent you from making good investments. So when you are championing deals, you probably run into some of like certain biases that you'll see that other investors might run into who are in the startup world, such as like fear of missing out, meaning you find a good opportunity, you fall in love with it. Or maybe the sunk cost fallacy, you put all this time researching a deal and it turns out it's not good, but you want to press forward. What are some of the cognitive biases that you see angel investors making and mistakes that are happening when it comes to investing?
As a starting point, like the first one is a fear of missing out, especially if you are new to angel investing. And if you have an experienced entrepreneur that you are dealing with, like, or an entrepreneur who has like very good sales skill, they might create that like fear of missing out, because fundraising is exactly like the sales cycle. And entrepreneurs, like experienced entrepreneurs, create that like sense of urgency that this has to be done now. So as an angel investor, you might really feel that, and you might make a decision that may not be right, or you may not go through your typical process and make an early decision because of that fear of missing out. Like things are moving forward, and if you don't make that decision, it's going to move forward. So the number one is like fear of missing out. The other one is exactly how you describe, like once you do a lot of due diligence and spend a lot of time, like you get invested emotionally to the deal, and you may want to do the deal just because you build a good relationship with the entrepreneur. Like it really happens. Like, you spend time, you get into details, you just love this person. Like it really happens. So then saying someone like, hey, I really like you, but I'm not going to invest is a very difficult thing to say. So saying no when you're emotionally invested is difficult. So it's important to separate that from like the emotions, and just take a hard stance that like in your mind that this is professional. I'm going to make an investment decision. I might become like very good friends with the CEO. That's fine, but this is like an investment decision. It's professional, so I need to take a step back. In order to balance this and not fall into these traps that you described, is to surround yourself with the right people, meaning your mastermind group, exactly how you described. So it's important to build close relationships with other angel investors, and if possible, like VCs, and figuring out a way to meet regularly, almost in a weekly or bi-weekly basis, that you can review deals, you can talk through your mind. You need to sometimes articulate like how you feel. Like you need to talk out loud. And as an angel investor, you are alone. Like you're a lone wolf. You are looking at deals, you are speaking in your own mind. So it is better to have that mastermind group that you meet regularly, that you talk through things. And it's also important to write things down. You are an angel investor. You don't need to present it to anyone. You can just, go to your bank account and then wire and just DocuSign the agreement. But it is from a discipline standpoint, not to fall into those biases. It's important to write an investment document. Why you made that decision, why you're excited, what you see in the market, what your expectations are. This is not only is a way to help you make the decision, but 2 years, 3 years from now, you will see like what you, how you made that decision, and it will help you to improve yourself in the next set of investments that you have.
That's beautiful, like an investment journal, because exactly. That ties into the next question, because how do you separate skill from luck? And it sounds like with that investment journal, you can then start seeing you can start focusing more on the process and not the results of the investing. Because sometimes your process and your thought process can be perfect. Like everything you did at due diligence was great. The market looked good. And it just turned out that a freak recession happened and your investment gets blown out. Yeah. So as an angel investor yourself, like what do you do to improve your processes and to make it so you're making better decisions over time? Because it seems like there's a big gap between the investment you make and the results that happen 7, 8, 9, 10 years from now.
Mm-hmm. Yeah, the angel investment, VC investment is luck is involved. Like, of course, there's skill that helps you to not to make bad investment decisions. The process, you need to follow the process. That process helps you be a better investor, not to fall into, not to make bad investment decisions. But that process also helps you, how you made that investment decision that you thought that was really good. It could be a really good rationale. But exactly how you said, there might be a recession, or there might be something that is like so unexpected that you did not think about. And then the next time that you run the same process, then you have that checklist in your investment process. So long story short, like luck is there. Like if any angel investor or VC comes and says like, I know the next, unicorn, the next investment, no one knows that. The people that are successful in this business are long-term thinkers, patient, and following a process. Those are the people that I'm also observing that are, clear thinkers and, and how, I see them like why they are successful, following this recipe of process and basically just being, true to their core values there.
Fantastic. I think Naval Ravikant says, be patient with results and impatient with action. So focusing on what you can learn, develop yourself and whatnot, and, being patient with the results of the investments. So interesting. So thank you. Last thing I want to get to is information sources. I want to ask you about 3 books that are important to you. So first book is, what's a book that you read that has made you a better angel investor?
The book's title is Angel, written by Jason Calacanis. It's a great book. Okay. Every angel investor should read that.
Awesome. What is one book you have read that has made you a more effective thinker?
More effective thinker is Fooled by Randomness by Nicholas Taleb. It tells you exactly, like the mindset of many investors and why the luck exists, and you just need to be like, process oriented.
It's a fantastic book. He also wrote Skin in the Game too, which I gave him some research for in the book, and he included it, and I was like really shocked. I was like, oh my God, he actually read my email. What is one book you have read that is unrelated to investing but gave you another way to analyze problems? So it could be something like biology or anthropology or politics or something else.
Yeah, I have I have two books that come to my mind that is irrelevant from investing. So one is Innovators.
Okay.
It tells a story of the computer revolution, written by Walter Isaacson, and covers biographies of many people who contributed into this what we call digital or computer revolution. So it shows like the trends and how those things happen, the short window of opportunities that happens about, like creating new technologies and businesses. And the second book that I really liked was Why Nations Fail. It shows like how nations succeed and how nations fail. And how, like, for example, United States has become like the leader of the world now from an economic standpoint, and how other countries in the history has become and how they failed over time. And I like the way of thinking, like, inclusive economies, inclusive, and giving opportunities for individuals to thrive and be successful. So I really liked How Nations Fail book. I highly recommend that.
Fantastic. I'll have to check it out. So thank you, Yeats. I really appreciate it. This interview was just jam-packed with just awesome nuggets and words of wisdom. So thank you for joining us. Where can we find you if we want to reach out? What's your website? What's your Twitter handle?
So the website is VELA, Vela Partners, PARTNERS. And my Twitter handle is the first letter of my first name and my surname. So it's YIHLAMUR, Ihlamur.
Okay. I'll include a link for that one.
Fine.
I have Thibodeau as a last name, and so I'm just like, whatever. JT at JBT blog. Cool. Well, Yeats, thank you so much for joining us. I really appreciate it, and thank you for sharing all this information. And we look forward to hearing about all your continued success in Vela Partners. And you have a great day. Okay. Hey everyone. I hope you enjoyed that episode. If you did, please hit the like button and please subscribe and share it. If you are a current or former tech employee and you want to join the Silicon Valley Investors Club, please head over to svinvestorsclub.com. If you want to subscribe to the monthly Investors Therapy newsletter, please head over to investorstherapy.co and you can subscribe there. Have a great day. Thank you.